welcome back. We're now joined by Pratik Oswal, head of the passive funds business at Motilal Oswal AMC, to talk about the best asset allocation strategy using the passive way. Hi Pratik, good afternoon. I understand you have an NFO ongoing, the asset allocation passive fund of funds, right? So two things. One, as an investor, why should I not opt for the existing category, the multi-asset funds, right? And two, why a fund of funds? I mean, why not an index fund or an ETF fund that actively invests in all of these, the subcategories?
Right. Thanks, Mera, for having me out here. And so essentially, these two funds, I mean, how is it different from the other multi-asset funds? I do feel that, I honestly cannot think of any fund that comes close to the funds that we're offering today. I would actually not compare this fund to, say, a multi-asset fund or a fund with different asset classes, but actually to a portfolio. Because, I think this is essentially for an investor, he or she is getting a portfolio of multiple asset classes, and we will be ensuring that this is an asset allocation portfolio where the weights, suppose you invest a 30% or a 40% in equity, that weight will stay exactly the same for the life of the fund. So essentially, this is more of an asset allocation fund. And the whole idea behind this fund is to offer an investor a simple portfolio. And really solves the needs, a lot of problems in the market today. Because, today a lot of investors are confused about what they should invest, how much they should invest, what sort of asset classes they should invest in, and how do they rebalance. If you look at both these funds, they offer you two different risk profiles. One is a conservative, one is the aggressive one. And both will give you essentially a fund that gives you exposure to all four asset classes, gives you a portfolio, and we also rebalance or manage it for them in a very low cost, in a passive way.
So are you suggesting that this be a replacement for someone's debt portfolio?
I wouldn't say that, so essentially I mean, this is not a replacement for any fund. This is essentially something that mirrors someone's portfolio. Today, I think most investors are expected to have a portfolio of 5 to 7 mutual funds. And essentially, if you look at most portfolios today, they would have essentially a combination of funds in different asset classes. So this essentially is made to mirror that particular portfolio in a much more simplistic way.
Okay, so, essentially like basically small ticket sizes where you can't afford to, have too many funds, look after them, a small investor maybe, could look at this as, the one go-to option. Okay, so I take that, but, I'll tell you what my doubt regarding the fund of funds is, right? Now, as an active investor, what I like to do, and I hope that everybody who's been a regular viewer likes to do it too, is to, check the underlying, right? You check the quality of the portfolio, you check the fund manager, except in a fund of fund, I'll be doing it 4 times over. Okay, and then I come back and I'll be having to check the credentials of the guys who are doing the rebalancing, right? That's another 4 people. I mean, is my effort worth what I'm going to be getting back from investing in a fund of funds?
Yeah, so I would say that this is the exact opposite of what we're trying to achieve with these two funds. Is that essentially what we're saying is that if you had to buy one fund which acts like a portfolio, this would be it. And essentially, just to give an analogy,
no, but how do I keep track of it? I mean, it's okay for you as an AMC to say that this is it. I'm going to do it to the best of my ability. As an investor, I want to keep the reins in my hand, right? I want to also know what's happening. I mean, is it not too much work for an investor?
Yeah. So if you look at, I'll give you an analogy. If you look at long-term returns, say returns from a 60 or an 80 or a 100, maybe from a 20 or 30 year perspective, what studies say is that 90% of your long-term returns is not dependent on what fund you buy or what stock you buy or what stock you sell. It's dependent on your asset allocation. So how you deploy your money across different asset classes is 90% of an investor's role. Whereas today, most of us, and this includes me, spend our time in trying to figure out whether to buy this fund versus that fund. It's actually irrelevant. What really matters is really how you allocate these assets. So essentially, what I'm trying to say is that it's if I replace any of these underlying funds with some other fund, then it really will not make a difference to the returns at all. It will be exactly the same, or I would say fairly similar. So essentially, the whole idea behind this is that someone who
point, Pratik, theoretically, I take your point that as a long-term investor, it doesn't matter what you choose, except if you've chosen the fund that goes down, right? So, I mean, my only point was, is it too much work? But the other thing is that see, I'm a proponent of asset allocation too. I think there is no other, no replacement to wealth creation apart from asset allocation. But the big impediment for doing asset allocation the mutual fund way is that there are just too many NFOs. Okay, so last year I counted there were 115 NFOs. So how do you stick to your glide path when you have an RM calling you day and night saying, you know what, you have your asset allocation right, but this next fund is going to do it for you? I mean, aren't there just too many NFOs, and isn't that the biggest impediment for a small retail investor to stick to his plan?
Yeah, I mean, I think I actually completely agree with you, and I'm part of the problem. This is my 9th or 10th NFO in the last 16 months. Luckily, I would say 80% of my NFOs are sort of newer sort of categories and products. But I do agree, honestly, for any investor combined, any investor, I would just block out the noise and just invest in my asset allocation and do nothing else. It's just that, today there is not really a lot of products out there that can really help retail investors do asset allocation for retail or for passive products, which is where, I think I've managed to spend some time and develop those. But I mean, I'm completely on that. I would say that most NFOs are not really useful, to be honest. And if a person just finds a simple fund and stick to that fund for a very long time, that is actually the best strategy that I can think of.
Pratik, appreciate your honest admission on that count. But one more thing about this fund of funds, you have the aggressive and the conservative funds, right? I mean, two different kinds of investors. What is the best environment for the underlying strategies to work, and what would be an environment that might produce a subpar result?
So these are essentially asset allocation products. So they're essentially an all-weather product for your portfolio at any point in time. If you are someone who can take more risk, then essentially you should have, say, an 80-20 or a 60-40 portfolio, which is what these funds are trying to give you. So essentially, the whole point about these products is to not really give you high returns, but to reduce risk in your portfolio completely. If you look at both of these funds, you have no market timing risk. There is no fund manager. You don't take a call of when to buy equity or when to buy debt. We have a fixed allocation, which will be stagnant for the next 100 years if the fund survives. So there's also no domestic market risk because we have some international out there. We have no credit risk because we're buying a GSET fund. And we're also hedging volatility by having some gold out there. So essentially, you're getting a fund which really has a very, very, very stagnant asset allocation, something you can keep for the rest of your life, and not really, I would say, bother about any of these existential risks that happen. Yes, these are not 100% equity funds. Yeah. So yes, in a bull market, that what we've had in the last 1 year, because you're underinvested in equity, you will obviously also underperform, I would say, like a Nifty 50 or another equity fund. But those obviously come with a lot more risk. So essentially, you're getting something which is sort of like an all-weather product, because that's number one. Number two, also, I think today's market is sort of confusing when all asset classes are pretty expensive. Gold was the highest performing asset class last year, and debt is also a little bit confusing with the yields. So by investing your money in an asset allocation product, you're essentially taking a bet on 4 different asset classes that are completely uncorrelated.
Right.
But that means that they don't really move together. So essentially, if tomorrow equity goes down or gold goes down or international goes down, the other 2 or 3 asset classes will give you a huge amount of downside protection. So essentially, that is also something which is a tenet of multi-asset or asset allocation funds.
Yeah, that's the principle, right? Winners keep changing. Pratik, thanks very much for your time this afternoon. And like Pratik said, don't worry about the returns. I mean, we're in the business actually of managing risk. This is what one of the fund managers had said, and I think this holds true whenever you're planning your portfolio. We'll wind down on MF Corner, but do stay tuned. The news continues with CNBC TV18.